in just 30 days. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the U.S. isn't ready for what's coming, and this is something the central elite, the political elite, and not even consumers see is coming. You're not going to believe where the next crisis is about to come from. Now let's go to Zero Hedge, where we picked today's story up with a headline: reverse repo liquidity plunges below key level. And that's a big issue as the Fed's quantitative tightening stalls. And this whole issue with overnight reverse repo, this is believed to be injecting liquidity into the U.S. economy. It's drying up and drying up very quickly. And the timing of this for March is a dangerous position, as you're about to see, because after a big drop at the end of January, the Fed's quantitative tightening has stalled in February, but that's just more of a calendar issue here, as the Fed has to deal with maturity dates. So when they go through a period of a week or two where there's just nothing maturing, well, they don't have much to unwind. But we've heard repeatedly from Chair Jerome Powell that he said that quantitative tightening is going to continue to run even after the Fed starts to cut rates. As of right now, there's no indication that there could be any rate cuts until third, maybe fourth quarter at best now, thanks to a hot CPI. And we'll look at, of course, the hot PPI that came out today. But what's coming in the banking system is going to spark a massive reversal in policy, perhaps as soon as next month. And of course, the Fed would not stop quantitative tightening without a statement, and this stall and its selling down by its book is more likely of a technical event, again, having everything to do with settlements and timing, as Zero Hedge notes. But it's worth paying close attention to because bank reserves at the Fed declined modestly last week as the U.S. equity market capitalization remains significantly decoupled. And there's a lot of people that believe that the Fed has some sort of magic control over equity markets, that markets respond to Fed putting liquidity in the system. Of course, this is really a false belief because most people don't even understand how QE, let alone QT, works, and it has nothing to do with the equity market other than the fact that it gets people to buy when the Fed is doing QE, and it should cause people to sell when they're doing QT. But in this case, as you can see, there's a massive decoupling here as the Fed continues to unwind its balance sheet, as we see securities held outright. This is, of course, the Fed's balance sheet in blue, and here we can see that in red is the Wilshire 5000 or total U.S. stock market, that it's been rallying against the face. Of course, the Fed is cutting its balance sheet. Remember, everyone used to say, don't fight the Fed. Well, this is the case. You've got high interest rates. You've got a balance sheet unwind. Everybody is indeed fighting the Fed, but one way that you can always be a winner is by taking advantage of our tools to help you be a better trader. Now, I looked at the reports today, and on page 1, we have over the week put out a bunch of trade signals for you. Many of you said, just show us when the signals reverse. We don't need an update on them. We just need to know when they flip so we can look at what's buying. Well, that is now on page 1. Let's take a look at an update on a signal we haven't talked about in a while, and that is on SPY. This is our CTA Timer Pro report. Now, if you're just looking at this for the first time, this looks at the machine positioning the trade tens, hundreds of billions of dollars in the market. If you can be ahead of the machines, and we give you that advantage because we run a historical overlay. Here you can see on November 3rd, we see short covering coming off a deep level. This is a great indicator. Now we'll show on page 1 when that happens. We flip over to our Momentum Timer Pro report. This is a wonderful report. If you're trying to trade the MACD, the RSI, and all those other technical signals, you find you're getting in too late, out too early. It's really confusing. We smooth all those signals out into one report. We show you the 1 month, 3 month, 6 month momentum signals and the daily. Here we can see coming off of a 1 month sell window, we had a buy. That was our Paris signal on November 3rd. If you take advantage of both of them, you'd been up 15.53 by buying it open on this candlestick right here. And right now, there are three free reports available for a 1 month. 3. So you got to grit them before they're gone. If you get to checkout and there's nothing there, that's because 3 people beat you to them. Links in the description below, because no matter where the Fed's balance sheet goes, your trading account should be going higher, as the bank's usage of the Fed's bailout facility is near flat at record highs around $165 billion since the Fed cut them off from their free money arbitrage. And what was happening here is that banks were going to this emergency facility not because they needed as much cash, because they could borrow from the Fed and then go around and turn around and put the money back at the Fed in a different place and make money on the spread. Fed says, you know what, we're on to you. No more. That program is ending in sense in March. Now banks can still use it, but there's no arbitrage advantage. If you're going there, it's because you need cash, or maybe the banks are starting to look elsewhere, and that's the problem with reverse repo that's coming here in March. Because the final much needed source of liquidity at the Fed's reverse repo facility plunged $82 billion below the $500 billion mark for the first time since June of 2021, and it's on a glide path now to get near zero sometime in March or below what is considered to be a very critical level of $200 billion, and then at some point shortly thereafter get down to zero. Now remember, this is what money market funds use because there isn't enough collateral or T-bills in the system. So as the government's been running these massive deficits, of course we know that Treasury Secretary Janet Yellen has been printing out a whole bunch of T-bills. That's been good news for the money markets who desperately need them, causing this reverse repo to go down. The problem is many people believe this is a sign of liquidity and potential stress in the banking system, and when it gets to really low levels, the problems are going to happen. Well, that comes in March at the same time that bank term funding program officially goes away, and that could mean chaos in the banking system, something that not even the Fed, political elites, or even depositors right now are prepared for. And this was the biggest non-month-end drop since October, and quite a shock as overnight reverse repo usage had been relatively stable recently. The question then is, why is this dropping so quickly all of a sudden? What is the catalyst behind this? It's even greater surprise given the soft funding, as reverse repo volume tends to drop less when GC rates are low because of the 5.3 reverse repo rate is more competitive with market rates. So it's starting to smell like some desperate funding needs. Well, who could need cash and need a whole lot of it? Well, if you're thinking the banks, well, you've got it, because we know in the past they were going to that bank term funding program. Now, could they be turning to money market funds? Well, it's possible. So this is a reminder that the Treasury Borrowing Advisory Committee, which is a panel of investors, dealers, and other market participants that regularly counsels the department, noted that while most expect overnight reverse repo balances to run down to zero, there are some looking for a sustained low level in the 200 to 300 billion range. Well, look forward to March. That's where it's headed. The importance of overnight reverse repo levels was noted by Dallas Fed President Lori Logan, who said in January the central bank should slow its balance sheet run-up. Now, could you imagine putting the restraint on QT? Of course, we go back. Fed Chair Jerome Powell said, look, we're going to be cutting rates well ahead. We're going to let this balance sheet continue to run down. Here you have Lori Logan saying, well, wait a minute, maybe we need to slow the pace here. Let's take a look, because as reverse repo balances approach a low level, she said this could be a problem. And all this means we're right on cue for March Madness as bank term funding program matures and banks are forced to fund their $160 billion hole through the discount window. So why does this look like a desperate funding need? Well, if you don't want to go to the Fed's discount window, even though the Fed's telling the banks that, look, it's okay, you can go here, you can get money from this, they're not looking at the bank term funding program anymore. So what could they do? Well, they could be going to money market funds and say, hey, look, we'll take some of your cash that you've got. Of course, with that, we'll also pay you a better rate than you can get somewhere else because we are desperate for it. Of course, that means that all of a sudden that reverse repo demand starts to plummet as money market funds turn to the banks to get their cash needs met, whereas banks are then desperate to get that cash because they're short of it in a big way. And that is a problem because in March, this whole thing could blow up and we could find the Fed starting to even cut QT, maybe even go back to QE to get bank deposits up. And what would that mean? Well, it means the overnight funds rate would start getting cut in a big way and we'd be back to QE before long. If you could only imagine in the next 30 days, this is all going to happen. And here we can see, of course, where this overnight reverse repo has a relationship with the Fed's balance sheet. Here we can note in red, overnight reverse repo coming down faster than, of course, QT is bringing the Fed's balance sheet down. A reversal here in QE would put reserves back into the banking system. And again, at a time we know they're very desperate to get them. But does the Fed see this? Well, according to Bostic, not at all. He says it may take some time to hit rate cut threshold. Now, I want to preference this by saying that when the Fed talks about cutting, they're just so fixated on the consumer price index. But remember, they never actually follow the CPI. If they did, they would track it very closely. We could see the relationship. There's absolutely none, as I'll show you, but a banking crisis. Well, that would get the Fed cutting in a big way. And the evidence from the data, our surveys, and our outreach says that the victory is not clearly in hand. Well, Bostic, wait till the banks need cash. We'll see what happens then. And leaves me not yet comfortable that inflation is declining to our 2% objective. That may be true for some time, even if the January CPI report turns out to be an aberration. It likely is, because keep in mind, the Bureau of Labor Statistics changed how they compute the CPI. They went more with a focus on services. So look, we was bound to actually see somewhat of an increase here. The overall trend, as I'm going to show you even more data, suggests that, again, consumer prices growth is slowing. And we'll get to the Fed's 2% target before long. Because let's take a look at the consumer price index against the Fed funds rate. And we can note that if indeed the Fed was tracking it, which they're not, you would never see them cutting well ahead of a peak of consumer prices, which we see here going into the early 1990s recession. They were cutting before the dot-com bubble. They were cutting even into the global financial crisis when inflation continued to go higher. And here you can even see into the pandemic, just before that, we were headed into a globally synchronized recession. Fed cuts, inflation goes up. It doesn't make sense that the Fed is so fixated on the consumer price index when history suggests they don't even care about it. It's just a talking point to keep rates where they want for now until they're forced to cut, which again, could come as soon as March, when the Fed may have to go back to QE to get deposits up in a big way. I require more confidence before declaring victory in this fight for stability, said Bostic, who's a voting member right now. My expectation is that the rate of inflation will continue to decline, which we completely agree with, but more slowly than the pace implied by where the market signals monetary policy should be. Well, Bostic, the market is usually right about this one, not you. Your history is pretty bad on this one. Right now, a strong labor market and macro economy offer the chance to execute these policy decisions without oppressive urgency. That is, until something very urgent comes along, and that could be disaster in the banking system when they're so desperate for cash. The money market funds don't have any more to give them. The overnight reverse repo is drained down to zero. The bank term funding program is closed, and everybody's starting to turn to the discount window, which the Fed now says is okay to go to. But the public doesn't. That tells you crisis mode, and that would get the Fed's attention in a big way. As he pointed to anecdotal evidence, as business contacts carry the ring of expert optimism, perhaps even pent-up exuberance that could unleash a burst of demand that could reverse progress on inflation, he suggested. And of course, while they may be looking at that, it could be the fact that we know that demand is so weak that any hope is getting them excited. Data says, well, don't get too excited for now. As we've noted over yesterday's show, continued claims continues to be a huge issue, and it's going to be a massive drag on demand. Producer prices, though, let's take a look at that, because the data suggests that while we're seeing a bump up in producer and consumer prices for January, it's going to be short-lived indeed, just like Bostic's short-lived view that they're going to not cut rates until third, maybe fourth quarter this year. As U.S. producer prices increased by more than forecast in January, as the final demand increased 0.3% from December, and the gauge slowed to 0.9% from a year earlier. The so-called core, which excludes volatile food and energy, climbed 0.5%. That's a big jump, and 2% from a year ago, also beating expectations. Of course, that caused interest rates to jump a little bit, and the market to kind of choke on that number, suggesting that perhaps the Fed, if it was fixated on these data points, would keep Fed funds rate higher for longer. banking crisis is one great way to get the Fed's attention where they could care less about where prices are at. But when we take a look at producer prices by final demand in red against the consumer price index, we can see there's quite a gap here, suggesting that indeed consumer prices are likely to head down in the future here. Right now, what we're seeing is producers trying to take advantage of as much margin as they can in consumer prices, because they know the economy is slowing, and at some point, this price gains are going to go away, and quickly. And the Fed will be concerned by January CPI and PPI reports. This is from the chief economist at Comerica Bank. Momentum has built up in inflation over the past few years and persists in many corners of the economy because, of course, inflation is all about momentum. It has nothing to do with anything actual. Well, we know that's not true at all. It has nothing to do with momentum. It has everything to do with supply and demand. And right now, what we're seeing is supply is starting to outpace demand. Watch out as we come out of that fourth quarter of last year. Demand is indeed turning lower here. And despite lower prices for gasoline, basic foodstuffs, and durable goods, yes, we'll see eventually inflation come back down in a big way. And one reason economists at the Fed and Wall Street parse the PPI report is because several categories are used to inform the Fed's preferred inflation measure, the personal consumption expenditures price gauge. January reading of the PCE is due later this month. That's the one the Fed really cares about. Well, don't worry, the Fed only cares about the one that supports their view of keeping rates higher, because there's further evidence that the U.S. economy is indeed slowing. Not only importing deflation, we're exporting as well. And again, this all eventually shows up in this headline numbers. And here we can see the export price index down minus 2.4%, the import price index down minus 1.3%, both year over year numbers. And you look at this from the bank's perspective. How do they make money? Well, they make money lending. And when the economy is expanding, they're going to do more loans. They're going to create more deposits. The problem is, in a contracting economy, banks lend less. In fact, more loans start to get paid off than are originated. That actually ends up destroying money, puts the banks in a dangerous situation here. Then again, we make the case as soon as March, when the overnight reverse repo drains down, could cause the Fed to outright panic. And here we can see the consumer price index in blue against the import price index for all commodities in red. And sure enough, we can note that when that red line is in deflationary trend, which is anywhere it's below the horizontal black line, that causes the CPI to either trend down or stay flat. In this case, we can look at producer price index from final demand, make the case why indeed inflation is coming down, because the global economy here isn't expanding. And when the global economy doesn't expand, well, that means you're going to see import and export prices continue to fall as supply begins to outpace demand in a remarkable way. Here we can see, looking back, this is the trade deficit. You can note in periods where you see the blue line heading up, that means trade is decreasing, and that means the global economy is indeed shrinking as well. And it tends to only happen going into recessions. Well, here you can see it now, the trade deficit continuing on a glide path to shrink as global demand goes down, and that tells you that consumer prices are headed down, and we're on path for a banking crisis as well, as there isn't enough money to serve all of the debt, perhaps all, and even all this toxic debt that's been created over the last decade. It's dangerous, and it's all going to start to come loose, potentially as early as March. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.